Neil Dutta is here. He's head of U.S. economics at Renaissance Macro. Neil, it's good to have you. And aside from the fact that we've been waiting a while, what fundamentally makes you think that this cycle still has legs?
Well, I mean, when I look at the near-term economic outlook, what I see is a labor market that's holding up at a time when headline inflation is likely to moderate. That's going to push real incomes higher. I think people will end up spending that money. Obviously, the housing market has been a big surprise this year. Remember, Kelly, this time last year, the housing market was a significant source of concern. You know, we heard housing is the business cycle, the most important leading indicator. Well, housing is now turning up. We've seen new home sales rise 7 of the last 8 months, and we all know what mortgage rates are. And, you know, I mean, whether builders can continue to sort of buy prospective buyers down to 5.5% remains to be seen. But at the end of the day, new home sales represent signed contracts, okay? And so a contract is signed, a home is built, people move in, and then they fill it with stuff. So that's why it's an important leading indicator. And we obviously know that fiscal policy is much more of a tailwind for the economy now than it was this time last year. So I think the time to be really concerned on the economy was actually this time last year. And a lot of those headwinds that we were concerned about, whether it was food and energy prices, very, very aggressive Fed, I mean, they're all sort of going the other way right now.
So I love the fact that you're highlighting housing and fiscal in particular, because you almost can't argue with that. I mean, it's absolutely true, and housing is not behaving. It definitely turned ahead of time and is kind of turning now. But more broadly, we are seeing some consumer cracks, right? When you look at the delinquency rates and some of the things that are going on there, you know, Red Book retail says, I mean, we're starting to approach the kinds of softness that are typically recessionary. And it feels like if that weakness sets in, that it kind of will overcome, because it's so much larger, any firmness we might see, for instance, in the housing market.
Well, I mean, let's talk about the fundamentals for the consumer, right? I mean, pointing to the Red Book index, which, you know, I mean, it was really, really high immediately after the pandemic, and now it's basically flat. I mean, I don't think year-over-year changes, which is how the Red Book is reported, really tells you much about short-run swings in activity. We also know that we're seeing record travel. I mean, if you look at the TSA as an example,
what's going on with Disney? I totally take your point, but Disney and some of these little areas, you know, other little areas of the travel market, you think there's anything going on there, or just idiosyncratic?
I think let's just talk about the fundamentals, right? The labor market is fine. We actually had, I mean, aggregate incomes rose quite sharply in June. When you take the sum product of jobs, hours, and earnings, that rose, I think, 0.8% over the month. But to me, it's just undeniable that the labor markets are going to hold up better than price inflation. As inflation moderates, that's going to take pressure off of household budgets. That's going to mean stronger real income growth. What will people do with that real income? They'll go out and spend it, particularly at a time when consumer confidence isn't strong, but it's getting better at the margin, not worse.
So final question, because you're a very, very good sparring partner, and I just want you to address one of the things that I do see making the rounds a lot, and is we have seen an uptick in delinquency rates. So, you can slice and dice it however you want, but we're going back to levels that are, traditionally more associated with periods of consumer weakness. What does that tell you? Because again, most people who are arguing for consumer strength, excess savings, all the rest of it, why are we starting to see people falling behind meaningfully in that way?
Well, I think you're seeing normalization in some areas of credit. I wouldn't call delinquency sort of an economy-wide problem. I would just say that there are some areas where you have issues among certain cohorts of consumers. But I think when you talk about macro, at the end of the day, auto sales are rising, home sales are rising, and that wouldn't be happening in a negative macroeconomic backdrop. Those are some of the most credit-sensitive areas of the economy. And people wouldn't make those purchases if they were very, very worried about the outlook, because those tend to be irreversible. You can't buy a house and say, oh, not going to do it after you sign the contract. So I think that tells you a little bit about how people feel about the outlook.
I think it's very well said. Neil, thanks for joining us. Appreciate your time today.